NIO stock has been making waves again, with a weaker volatile yet undeniably bullish movement. Shares surged by double digits earlier in the week, then cooled off slightly, only to bounce back on Friday with a nearly 2% gain on high volume. But even with this momentum, a significant question remains: why is Wall Street still betting against NIO? And more importantly, who's actually winning the battle for this stock's future? Retail investors or institutional short sellers? Let's unpack that. To understand this tension, you first have to look at the stock's recent behavior. NIO has been on a tear, driven in large part by a wave of optimism surrounding its new Onvo L90 SUV, stronger than expected revenue growth, and expanding battery swap infrastructure. Earlier this week, the stock gained over 10% in a single session, one of its best days in recent months. Volume skyrocketed, indicating that this wasn't just a few traders jumping in, this was movement. Real interest. Real momentum. But while the stock gained traction, short sellers didn't back down. In fact, as of the most recent data, roughly 10% of NIO's float remains sold short. And it's not just the size of the short interest that's notable, it's the conviction. The borrow fees to short NIO remain elevated, suggesting that bearish investors are willing to pay a premium just to keep their positions open. That's not something you do unless you're convinced the stock is heading lower in the medium term. It signals deep skepticism, likely rooted in concerns about profitability, Chinese macroeconomic uncertainty, and fears of overcompetition in the EV sector. But here's where it gets interesting. On the other side of this trade is an energized army of retail investors who continue to see NIO as undervalued, underappreciated, and on the verge of a turnaround. If you scroll through Reddit forums, Twitter threads, or StockTwit streams, there's no shortage of bullish sentiment. These investors point to NIO's expanding delivery numbers, its unique battery swap model, and its potential to tap into a broader, lower-cost market through the Onvo sub-brand. Some even compare NIO's current trajectory to Tesla's early years, riddled with doubt, heavy short interest, but ultimately explosive in the long run. The difference in belief systems between the retail crowd and Wall Street could not be more stark. Institutions continue to tread cautiously. Many analysts still hold neutral or even underweight ratings on the stock. There haven't been many meaningful upgrades lately, and most institutional investors remain hesitant, likely due to the uncertain regulatory environment in China and the perception that NIO is burning through cash without clear profitability in sight. Retail traders, by contrast, seem undeterred. They're betting on growth, innovation, and what they see as a strong national brand identity in one of the world's largest EV markets. And as we saw this week, when retail sentiment gets hot, NIO can move quickly and with serious volume behind it. So what could tip the scales? Let's start with fundamentals. If NIO posts a surprisingly strong earnings report in early August, particularly if it beats margin expectations or shows signs of break-even progress, that could be a game-changer. Analysts may start to reconsider their positions. Institutional money might slowly re-enter. And that short interest? It could start to unwind. That's how short squeezes happen, not in a vacuum, but in a moment when the bears are caught off guard by better-than-expected results. Another potential catalyst is the Onvo L90. If test drives go well and reservation numbers look strong, this could validate NIO's strategy of expanding into the mass market segment. The L90 isn't just another SUV, it's a symbol of NIO's attempt to diversify and scale. A hit product here could inject real optimism into the stock. Then there's battery swap. While still controversial, this model has begun to show signs of viability. Around 20% of NIO's battery swap stations are now reportedly profitable. The company has over 3,100 of them across China, and they're now scaling up their next-gen stations which promise faster swaps and higher throughput. If NIO can prove that this infrastructure can be monetized, Wall Street will have to take another look. So where does that leave us? Right now, NIO is a battleground stock. On one side, you have institutional pessimism rooted in near-term financials and macro risk. On the other, you have retail belief driven by innovation, infrastructure, and long-term upside. Neither side is completely wrong. But history shows us that when innovation meets execution, and when retail and fundamentals align, stocks like this can defy the odds. As we head into next week, the momentum is clearly on retail's side. Friday's rebound shows there's still gas in the tank. All eyes will be on earnings, reservation updates, and any signal that the tide is turning. So, what do you think? Is NIO still a long shot, or is it being underestimated by Wall Street? Drop a comment below and let me know whether you're team retail or team short seller. And if you're enjoying this journey with NIO, hit that like button and subscribe for more updates as the story unfolds. Thanks for watching, and I'll catch you in the next one.